You've been saving for 5 years and you're still broke. Not because you're bad with money, but because you haven't reached the tipping point yet. I need you to understand something that's going to sting at first, but it's the truth you need to hear. Right now, you're doing everything the experts tell you to do. You're working overtime, cutting out the daily coffee, meal prepping, saying no to vacations, watching your savings account grow by $50 here, $100 there. You've read the books, you've set up the automatic transfers, you've downloaded the budgeting apps, and yet, when you look at your net worth, when you really stare at that number, it feels like you're trying to fill an ocean with a teaspoon. Every dollar you save feels like it's evaporating before it can make a real difference. The math is working, technically, but it doesn't feel like it's working. You're exhausted, and the finish line seems to be moving further away the harder you run. But here's what nobody tells you about wealth building, and I mean nobody. There's a specific dollar amount where everything changes. Not gradually, not subtly, dramatically. It's the moment when your money starts working harder than you do. When you wake up on a random Tuesday morning, check your investment account, and realize you made more while you were sleeping than you did in an entire week of work. When compound interest stops being this abstract concept in a finance textbook and becomes your most productive employee. This isn't motivational nonsense, this is mathematics. Cold, hard, beautiful mathematics that doesn't care about your background, your degree, or your current salary. It only cares about one thing. Did you reach the threshold? In the next 15 minutes, I'm going to show you the exact mathematical threshold where the snowball effect activates. I'm going to explain why your first $100,000 is psychological torture, but your second $100,000 takes half the time. I'll walk you through the 3 acceleration triggers that transform passive saving into exponential wealth building. And I'm going to give you real numbers, real timelines, and the brutal truth about how long this actually takes. No sugarcoating, no get-rich-quick fantasies, just the data that wealthy people understand and broke people never see. Stick with me, because understanding this will fundamentally change how you think about every dollar you earn from this moment forward. Let's start with why the first $100,000 is absolute hell. Here's the brutal math that nobody wants to talk about. If you're saving $500 a month with zero interest, it takes 16.6 years to hit $100,000. 16 years. With a 7% market return, which is roughly the historical average, you're looking at about 10 years, a full decade of discipline for 6 figures. This is why most people quit. This is why your coworker who started investing 5 years ago gave up and bought a boat instead. The numbers are real, and they're demoralizing. But here's where it gets worse before it gets better. In those early years, your contributions are 95% of your growth. Let me show you what I mean. Year 1, you save $6,000. With a 7% return, you earn $420. You worked, you sacrificed, you contributed $6,000 of your hard-earned money. The market gave you $420. It feels pointless, doesn't it? Your money isn't making money. It's making pocket change. The math doesn't feel different yet. Your returns are still smaller than your monthly contribution. You're still the engine. Your money is just sitting there, barely pulling its weight. This is the psychological breaking point where most people's wealth-building dreams go to die. They look at their account after 2 years, 3 years, 5 years, and they think, what's the point? I'm killing myself to save, and the compound interest everyone talks about is giving me enough to buy groceries for a week. But here's what they don't understand. Here's what you need to burn into your brain. The snowball effect isn't linear. It's exponential. And exponential growth looks like nothing is happening until suddenly everything is happening. Charlie Munger, Warren Buffett's partner for decades, said something that should be tattooed on every investor's arm. The first $100,000 is a bitch, but you gotta do it. He didn't say this to be crude. He said it because it's mathematically, psychologically, and emotionally accurate. At $100,000 with a 7% return, you're generating $7,000 a year in passive income. That's $583 a month your money generates without you lifting a finger. Suddenly, that number is comparable to your monthly contribution. Your money is now a part-time employee. Not a great employee yet, but it's showing up to work. Now watch what happens next. And this is where your entire perspective needs to shift. From $0 to $100,000 takes about 10 years if you're saving $10,000 a year. From $100,000 to $200,000, 6 years with the same contribution. From $200,000 to $300,000, 4 years. The snowball isn't rolling yet, but you can feel it starting to move. You can feel the physics changing underneath your feet. The same effort, the same monthly transfer, the same percentage return, but wildly different results. This isn't magic. This is mathematics finally working in your favor instead of against you. Now let me show you the 3 acceleration triggers that transform this from theory into reality. These are the specific mechanisms that turn your portfolio from a savings account into a wealth-generating machine. Trigger 1 is critical mass, and it happens when your returns exceed your contributions. For most people saving $10,000 to $15,000 a year, this moment arrives somewhere around the $150,000 mark. At 7% returns, that's $10,500 a year in passive growth. Read that again. Your money is now working as hard as you are. This is the crossover point, and it changes everything about how you think about wealth building. Before this moment, you're building wealth through sacrifice. You're cutting expenses, working overtime, saying no to vacations, driving the old car another year. Every dollar in your portfolio came from your labor, your time, your sweat. After this moment, you're building wealth through strategy. The psychological shift is profound. You stop thinking like someone who's trying to save their way to wealth and start thinking like someone who's investing their way to freedom. Let me give you a real example that makes this tangible. You have a $200,000 portfolio. You're contributing $12,000 a year, which is $1,000 a month. That's significant money for most people. That's discipline, that's sacrifice. But at 7% returns, your portfolio generates $14,000 that year. You contributed $12,000, your account grew by $26,000. You did half the work, your money did the other half. The machine is running. And here's where the timeline gets absolutely wild. Years 1 through 10 feel like pushing a boulder uphill. Linear growth, painful progress. Every milestone takes forever. Years 11 through 15, the curve starts bending. You can see it in your account statements. The numbers start moving faster than your contributions can explain. Years 16 through 20, you hit hockey stick growth. Your net worth is increasing by amounts that used to take you years to save, and it's happening in months. This is why wealthy people seem to get richer effortlessly. They're not smarter than you. They're not working harder than you. They've just passed critical mass, and the mathematics are doing the heavy lifting. Trigger 2 is the reinvestment loop, and this is compounding on steroids. Most people understand the concept of interest on interest. You've heard it a million times, but few people understand the behavioral loop that accelerates everything beyond the basic math. Let me break down the dividend snowball effect. You have $200,000 invested in dividend-paying stocks with a 3% yield. That generates $6,000 a year in dividends. Now, if you're smart, you're reinvesting those dividends automatically. That $6,000 buys more shares. Those shares generate more dividends. Those dividends buy more shares. You're not just earning returns anymore. You're expanding your money printing machine. But here's where it gets really interesting. The confidence multiplier effect. When you start watching passive income grow in real time, it changes your behavior in ways you can't predict until you experience it. You become more willing to take calculated risks because you have a foundation. You start recognizing investment opportunities everywhere because you have capital to deploy. Financial education becomes actually valuable instead of theoretical because you can implement what you learn. The knowledge you've been accumulating for years suddenly has somewhere to go. Then there's lifestyle arbitrage. As your passive income grows, you gain options. Let's say your investments are generating $1,500 a month in passive income. That's real money. You could reduce your work hours. You could start that side business you've been thinking about for 5 years. You could take a lower-paying job that you actually enjoy. And here's the kicker. Any of those choices might actually increase your investment capacity because you're happier, more creative, more energized. The snowball doesn't just grow from market returns. It grows from the freedom it creates, which creates more opportunities, which creates more capital, which creates more freedom. It's a loop. Trigger 3 is the velocity factor, and this is where the numbers start to look absolutely unfair. Your first $100,000 takes about 10 years with consistent contributions. Your first $500,000 takes about 15 years total. Your first million takes about 20 years. But your second million, 7 to 8 years. Same contribution rate, same market returns, wildly different timeline. This is the second million phenomenon. And it's not a trick. It's pure mathematics. Let me show you the math behind velocity. At a $1 million portfolio with 7% returns, you're generating $70,000 a year in passive growth. If you're still contributing $15,000 a year, which is excellent discipline, your total annual growth is $85,000. You're adding $100,000 to your net worth every 14 months. Think about that. What took you 10 years to achieve the first time is now happening in just over a year. The wealth acceleration table tells the story. 0 to $100,000, 10 years. 100,000 to 250,000, 8 years. 250,000 to 500,000, 6 years. 500,000 to 1 million, 7 years. 1 million to 2 million, 7 years. 2 million to 3 million, 4 years. This feels unfair, and I understand why. The system rewards those who survive the brutal early years. This is exactly why generational wealth is so powerful. Wealthy families don't start their kids at 0. They start them at the acceleration point. A 25-year-old who inherits $500,000 doesn't need to grind for 15 years to reach critical mass. They start with the machine already running. But here's the hope, and this is critical. You can get there in one lifetime with discipline. It's hard. It's a long game. But it's possible, and millions of people have done it starting from nothing. Now let me show you the dark side, because understanding what breaks the snowball is just as important as understanding what builds it. The withdrawal trap is the most common wealth killer, and it's devastating in ways most people don't realize. Pulling $30,000 from a $150,000 portfolio isn't just a 20% hit. It's resetting your timeline by years. You're not just losing the $30,000, you're losing all the future growth that $30,000 would have generated. At 7% annual returns, that $30,000 would have been $60,000 in 10 years, $120,000 in 20 years. You didn't withdraw $30,000. You withdrew your future. The lifestyle inflation trap is more insidious because it feels like success. Your portfolio hits $200,000. You're finally making real progress. Your income has increased over the years. You've been disciplined for so long. So you upgrade the car, you move to a nicer apartment, you start eating out more because you deserve it. And you do deserve it. But here's what happens. Your contribution rate drops from $15,000 a year to $8,000 a year. You've just added 3 to 5 years to every future milestone. The snowball doesn't break. It just slows down right when it was about to accelerate. This is the cruelest timing because you're sabotaging yourself at the exact moment when consistency would have paid off exponentially. The panic selling catastrophe destroys more wealth than any other single mistake. The market drops 20%. Your $400,000 portfolio is now $320,000. You've lost $80,000 on paper, and it's terrifying. Every financial news channel is screaming about recession. Your coworker is pulling everything out and going to cash. So you sell, locking in the loss. Then the market recovers over the next 18 months and you've missed the entire rebound. You didn't just lose the $80,000. You lost the recovery gains and you've broken the compounding chain. Starting over from $320,000 in cash while the market climbs back, means you're buying in at higher prices with less capital. The math is brutal. Here's what you need to understand about protecting the snowball. Once it starts rolling, your job isn't to make it roll faster. Your job is to not stop it. Don't withdraw for non-emergencies. Don't inflate your lifestyle faster than your passive income grows. Don't panic when the market does what markets always do. The snowball breaks from impatience, from fear, from thinking you can outsmart the system. It doesn't break from staying the course. You've built something powerful. Don't destroy it chasing short-term comfort or running from short-term pain. So what's the takeaway from all of this? It's not about getting rich quick. It's about understanding the math, staying disciplined, and protecting your snowball once it starts rolling. It's about recognizing that the early years are brutal, but the rewards are exponential. It's about understanding the acceleration triggers and avoiding the wealth-killing traps. And most importantly, it's about shifting your mindset from someone who saves to someone who invests. It's about building a machine that works for you, so you don't have to work forever. Think of your wealth-building journey like planting a tree. The first few years, you see nothing but dirt. You're watering it, fertilizing it, protecting it, but there's no visible progress. You might even start to think it's not working. But then one day a tiny sprout appears, and over the next few years, that sprout grows into a sapling, then a tree, then a forest. The roots are deep, the trunk is strong, and it's providing shade, shelter, and fruit. Your wealth can be the same. It takes time, effort, and patience, but the rewards are worth it. Start planting your seeds today, nurture them with discipline, and watch your forest grow. And remember, the most important thing is to just keep going. Even when it feels like nothing is happening, even when you're tempted to give up, just keep planting, keep watering, and keep protecting your future forest. The snowball is real, the acceleration is real, and the freedom is within your reach.